Hedge funds are at the top of the global financial system. They employ hidden and sophisticated investment strategies in order to maximize their financial gains from the stock market. The best fund managers can build billion-dollar personal fortunes, making running a hedge fund a tremendously lucrative venture. However, there is a dark aspect to the hedge fund industry because many of them make their billions through shady means. The most concerning example of this is the huge hedge fund SAC Capital. As soon as federal regulators learned of its heinous activities, it was obliged to shut down operations. In the 1990s and 2000s, SAC Capital, which was created by legendary investor Steve Cohen, was the most successful hedge fund globally. It produced a 30% annualized return during the course of its life and handled $16 billion at its peak. However, it now appears that at least part of these outstanding revenues were generated through illicit conduct. After their illegal practices were exposed, the once dominant hedge company was forced to cease operations and pay a record fine of $1.8 billion. In this video, we'll talk about the rise and stunning demise of the hedge fund SAC Capital. In 1992, Cohen resigned from his position to start his own hedge fund. He had previously been an options trader at an investment bank. Dealing options was his profitable profession, bringing in the bank over $100,000 per day. With $10 million of his own money that he had amassed in the bank and an additional $10 million from outside sources, he founded his own hedge fund. He gave it the name SAC Capital, which stood for Steve A. Cohen. SAC immediately experienced great success, with profits of up to 50% annually. There were a few crucial factors in Cohen's early years of success. First of all, his holding times were incredibly brief. He would purchase a stock in anticipation of a very particular event, such as the publication of earnings, and would typically hold it for 2 to 30 days. This contrasted sharply with the popular long-term buy and hold investing strategy of the day. Long-term benefit in order to determine a company's fundamental value in the market. Investors, like Warren Buffett, do in-depth fundamental analyses on businesses, analyze financial records, and conduct industry research. Cohen's method of day trading was really unique and required a totally different kind of data. He used a mosaic approach to information gathering, which involves getting in touch with a wide range of business professionals at major corporations. Imagine that you trade stocks in the construction industry, for example. Construction managers can be paid to speak with you and inquire about their company's performance in recent months. You could assume that construction companies will likely surpass their earnings estimates for the upcoming quarter if they say that business has been booming recently. If business circumstances have been declining, you can buy long construction stocks. By using this technique, you can sell the stock short. SAC Capital may forecast whether a firm would exceed or fall short of earnings projections, and could then take a short position in the stock just before the earnings announcement. When implemented properly, this strategy can be quite rewarding because you only need to hold a position for a short period of time. You can make hundreds of trades per year, which means that even if you only gain a few percentage points of profit on each one, your annual returns could still be very significant. Another factor in SAC Capital's success was leverage. They employed the long-short investment hedging strategy, holding long and short positions in several companies at the same time. You can fund your long bets with the money you receive when you short sell a stock. From 1992 to 2013, SAC Capital generated an annual average return of 30%. The huge returns of the hedge fund, net of fees, allowed them to charge astronomically high fees. In addition to receiving 50% of the earnings, they levy a 3% management fee on invested equity. By 2013, their assets under management had astonishingly increased to $16 billion, and Steve Cohen had amassed a personal fortune of almost $10 billion. As a result, he became one of the most prosperous hedge fund managers in history. Whereas the Mosaic method of information collecting was authorized. If you ask a business expert about the state of various companies today, they'll tell you that it's sort of a legal gray area. He is telling you a secret that not many people are aware of. This led to SAC's competitive advantage in the markets. They had access to information that was not available to other investors or business experts. Your conversation partner is not violating any commitments or duties owed to their employer. They are completely within their rights to give you non-public information. If they provide you knowledge that their company has not authorized them to share, it is insider trading in the U.S. Hedge funds that use the Mosaic method of information gathering must walk a very fine line in terms of the information they may obtain to make sure they stay within the boundaries of the law. This finally led to SAC encountering significant issues, as we will see in a moment. In 2007, the Securities and Exchange Commission started investigating SAC Capitals for insider trading as a result of rising concerns over its operational procedures. The probe started with Michael Steinberg, a longtime manager of the SAC portfolio. While trading in Dell Technologies stock, he learned about the company's quarterly results. The Dell insider violated a confidentiality agreement with his company and engaged in insider trading when he disclosed the knowledge. Using this insider information, Steinberg bought Dell stock, resulting in a $1.4 million profit for SAC Capital. The SAC Capital charged him with insider trading as soon as they learned about this. According to SAC Capital, Steinberg was part of the management that was considered renegade. The creator, Steve A. Cohen, and others adamantly denied knowing about the insider trading. Although to the average person $1.4 million would seem like a lot of money, in terms of SAC Capital, it was actually fairly little, which was responsible for managing more than $10 billion at the time. Steinberg may have been operating independently as a result. He made the comparably small trade just as SAC Capital's issues were starting to materialize. In 2008, Matthew Martoma, a separate SAC portfolio manager, had a sizable long position in the pharmaceutical company Elon Corporation, valued at hundreds of millions of dollars. This was a huge wager, even for the enormous hedge fund. Elon was working on an Alzheimer's drug. This may have been an enormous success for the company. This led to a binary outcome. Either the drug would be approved by the FDA, sending the stock surging, or it wouldn't, sending the price tumbling. When Martoma contacted a physician engaged in the drug trial, the physician let Martoma know that the experiment was not going well, and that the FDA would not approve Elon. Confidentiality agreements he had with his employer forbade the doctor from revealing specifics of the medication trial before they were made public. Despite knowing this, Martoma made the decision to act and advised his boss Steve Cohen to sell all of their shares of Elon stock and convert it to a short position. When they do this, they might profit from the company's disclosure of the drug trial's failure and the ensuing decline in share price. If you take into account the profits from the short position, as well as the losses that were prevented by selling their long position, gains from the transaction came to $276 million. The gain was the biggest insider trading profit ever recorded. The SAC Capital instantly flagged the transaction as suspicious. It seems a little strange that SAC Capital made the full 180 shift from a long to a short position immediately before the bad news was announced. When the SAC filed charges against Martoma, there was no ambiguity or murkiness in his case, unlike certain insider trading cases. He was a professional and had a wealth of expertise in the subject. He was aware that the doctor was breaking the law by divulging, yet he nonetheless made use of the information for his own gain. Despite receiving a $9 million bonus from SAC in the same year that he engaged in insider trading, Martoma was ultimately found guilty and is currently serving a 9-year prison sentence. Steve Cohen claimed that he was not aware that Martoma had access to the inside information, despite the fact that insider trading is specifically forbidden by SAC's internal laws. However, the statement was seriously contested by the prosecution. They learned that Martoma had informed Steve Cohen via emails of their holdings in Elon and the rationale for shorting the stock. Details in a few of these communications imply that Martoma had access to. Any rational person who read this email, according to the prosecution, should have been wary and curious about how Martoma got the information. Steve Cohen, the head of SAC, got hundreds of emails every day, including the dubious correspondence from Martoma, but he made no inquiry, according to Cohen's counsel, and only read around 10 of them. Due to the severe information overload, it was impossible to confirm that there was no insider trading going place. Cohen's legal position prevents the prosecution from clearly proving that he was aware of his subordinates' wrongdoing among the hundreds of employees at the hedge fund. Cohen was never specifically charged with any criminal offenses. Unable to prosecute Cohen in a criminal matter, the next best thing federal prosecutors could have done was to charge the firm with gross negligence. SAC Capital was accused with securities fraud in 2013. The government contends that SAC had a duty to keep an eye on its employees and make sure they weren't involved in any criminal activities. SAC entered a guilty plea and consented to pay a record-breaking fine of $1.8 billion. Additionally, they were barred for 3 years from handling outside funds. Cohen reopened the hedge fund and changed its name to Point72 following the completion of the 3-year suspension. Notwithstanding the SAC Capital's turbulent past, Point72 managed $22 billion after a remarkable turnaround, which is more than SAC ever managed at its peak. Well, with this, let's conclude the video for now. What do you think of SAC Capital and Steve Cohen? Thank you very much for watching, and if you have any feedback, please post it below. In the following video, we'll see you. Visionomics. Signing out.